I'd like to hand it over to Dawn to kick off the conversation.
Thanks so much. Good afternoon, everybody. It's so delightful to be here with you and with Greg and have the opportunity to be in conversation. Greg, I'm just curious, let's start at the beginning. People are often wondering, how does one become a venture capitalist? What was your background that led you to do this work to begin with?
Thanks. First of all, I want to thank everybody for asking me to join today. It's a privilege certainly to be here, and I'm coming to you from my office here in Silicon Valley, wishing I could be in Montana. But yeah, our summit's about to celebrate its 40th anniversary. 1984, I had just joined two founders that had been at TA Associates, which is another very successful private equity / growth equity firm. They had left, and they were looking for someone to help them raise their fund and go out and make investments. And so I joined them just right out of business school. And I'd had some background in corporate finance, some tech investing background, spent a summer at Goldman Sachs. But I was working with bigger companies at Goldman Sachs. I really wanted to work with smaller companies, a lot more. I really enjoyed the personal relationships, really enjoyed getting to know entrepreneurs and the companies and helping them grow. So little did I know what I was getting into, because at the time I joined them, we had no money. And so our first job was to go out and raise it. And we spent 9 months. We raised, at the time, was the largest first venture capital fund raised ever. It was $160 million, which sounds paltry today compared to what Summit is raising. I think its last fund was like $8 billion. So it was $160 million. We're now on, I think, on Summit 12, but that was Summit 1. And so it was just the three of us. And now that we had this money, we had to invest it. And we didn't know what we were helping create at the time, along with TA and a number of other firms that have since was what is now called growth equity, which is funding companies after they've come out of the early stage and need growth to accelerate their plans and grow their business. And our strategy was to find companies, for the most part, that have been bootstrapped on savings, an uncle's credit card, whatever. Find companies that have been bootstrapped, gotten to a certain level of have some customers, and then help them get to the next level. And that was our strategy. And the interesting, and no, realizing it's entrepreneurs that start companies. It's not venture capitalists, it's entrepreneurs. And at the time, less than 1 or 2% of companies had formal venture companies that were in the kind of overall venture capital investing universe had access to venture capital. And so we were looking for the companies that had been bootstrapped and were ready to go to the next level. We're also looking for companies that were interested in making a profit, which sounds they either had a path to profitability or a plan to profitability. You could see it, and it sounds a little bit sacrilegious, particularly during some periods that I lived through, like the dot-com boom, when profits were. I was once told that I was a dinosaur. Profits don't matter. And it turns out that in the long run they do. And so we're looking for companies that have a path, at least can show a path to profitability. So the interesting thing is these companies don't walk in our door. So we put together, a big part of our strategy was frankly a cold calling and a marketing a machine to help to find these companies and establish a relationship with them. A lot of times we'll establish a relationship with them and they say, we're not ready yet, maybe next year, maybe 2 years. And so that was I think that's one of the reasons for our success over the years, that we just haven't waited for the phone to ring and companies to come knocking on our door. And the reason we did that was for a couple of reasons. One, there's a self-selection process. We could target industries that we wanted to target. Two, if we find companies that have been at least through the 6 months, 12 months, a year, of 2 years sometimes of development, they've gone through, they've tried a couple things that haven't worked, so they've learned from that. They A lot of times there's 3 or 4 founders and they're down to 2 because they found out that they're not all working together. So they've gone through that. And they have, and then we can help them, once they figured out where their business is heading in general, we can help them go to the next level, help build their board, help them round out their management team, help them refine their strategy, etc. So it's our strategy very different from the early stage. We did not do the conceptual, here's a business plan and an idea. Although we did do some of that with entrepreneurs that we had backed in the past, and they come back for round 2. So it's a long way to answer your question, Dawn, but just so that was our strategy, and it was totally based on finding great people. And you've heard that a lot. That when somebody would walk in with a spreadsheet, and this was just at the early days of spreadsheets, by the way, in '84. Some of you remember Lotus 1, 2, 3, and walking with a spreadsheet. And here's my plan, in 5 years to be profitable and go public and all this stuff. And if an entrepreneur led with their spreadsheet, it was usually an indication that that was something we weren't interested in. We want to really understand the person, their ideas, their values, their principles. The spreadsheet, then that stuff comes later, down the road. It's more important to really feel like you can develop trust, develop a relationship, and we could talk more about other factors that we look for in investment. But it was, I called it, we're definitely in the frog kissing business. We had to kiss a lot of frogs, to find the right. We figured out for every 1,000 companies that we talked to or contacted, we invested in 1. And that was, again, we were in a target-rich environment, right, in California. We were based in California, Boston. Right now, we're California, Boston, London. Summit is. But it still is a highly selective, filtering process, the way Summit does its work.
So every entrepreneur wants to be the frog that you kissed. So are there factors that would rule them in and factors that would rule them out by definition?
That's a really good question, and there's no right answer. For us, it was I think what we're looking for with entrepreneurs are a few things. One is a sense of urgency. The world's moving really quickly, and that there's people who operate at a pretty fast speed. So we're looking for a sense of urgency. 2, we are looking for values that align with ours. Trust, honesty, transparency. And the fact that we're going to be partners, so to have that connection. My second deal that I ever did, and is I was defrauded. I was absolutely defrauded. I blame myself for I did not do my due diligence, and I learned a lot from that about how important the relationship with people and their values are. So I think sense of urgency, values, vision, and the willingness, some sign of risk-taking and resilience. You're not going to get it right the first time. It's just not going to happen, or perfectly right. It's rare that it does. You're going to go down one path and have to zigzag, and entrepreneurs that can rally from that experience and get energy from that experience versus going the other way. I think that is something we're looking for as well. Of course, also it helps to have customers as well, because it doesn't take 10 or 50, but a few that at least we can talk to, and there's some validation of at least somebody who may not have bought the product yet, but people we can talk to who might be interested in it. So that's certainly important. I spent a lot of time in higher ed as chair of my alma mater's board, and I always got worried when we didn't talk about students. When we were talking too much about faculty or building buildings, if we stopped talking about students, I got nervous. The same way in venture capital, if we stop talking about customers, I get nervous. And so therefore, entrepreneurs who are really, really customer focused is another factor we're looking for.
So are there industries that you would rule in or rule out, or were there particular sectors you were focused on?
That's a really good question. So because we're looking for companies that we're primarily bootstrapped on, companies that require giant upfront capital needs, semiconductors, drug discovery, frankly now AI, it would be sectors that we just didn't invest in, and it just was not. So what companies can bootstrap themselves through friends and family or whatever to get to a certain level? We always wanted to be the first venture capital investor. We don't like coming in Series E or Q or whatever. We wanted to be the first one because we wanted to have the relationship with the investor that a lead investor can have. And we also were very comfortable. In fact, 98% of our investments were in a minority position. So we're really comfortable in being a minority. Some venture capitalists aren't. They need to have control. We're very, very comfortable. And the only way you can be comfortable is building that trust. So basically, what kind of industries require not a lot of capital up front, but they can develop a little bit of traction? Software, obviously. Healthcare services was another area. Some consumer products. We did a lot in the networking sphere back in the 90s and the aughts. And business services as well. But very, companies that need a lot of capital up front. There's already an ecosystem. That's another thing. One more thing I want to mention is that when we entered the business in '84, Sand Hill Road was already established. Kleiner Perkins was there, Sequoia was there, a few others were there. And we said, okay, they're doing a really good job in that really early stage business. And then at the other end, you had the big buyout shops, doing later. And there was kind of a hole in the middle. So we try to do a little practice. What we preach was like, we had to be conscious of how we ran our business, and make our business successful. So we had some credibility, going to an entrepreneur when we're talking with them about advising them on their businesses.
So what about geography? Was that a major factor? Were you only investing close to home, or were you more broad-based than that?
We were willing to get on airplanes, which was, I think, a big hallmark of our success. I made investments in Cleveland, Ohio, and in Michigan, and in Wisconsin, but I'd say 40% of our investments were on the West Coast, 20% were in the East Coast, and another 30-40 in between. The South was we opened an office in Atlanta that was ill-fated, not because Atlanta wasn't a good area to invest in. We just didn't have the right person there. But I'd say we were willing to get on airplanes, and I had a lot of frequent flyer miles to show for it, because we're back to our strategy. We're looking for companies that other people haven't discovered. And Silicon Valley was, even though we did a lot of investments here, Silicon Valley is a pretty picked over area. And so that was another part of just one more thing to mention on geography. As well is I think also we're willing to invest in the non-typical entrepreneur. They didn't have to be a PhD from Stanford or Berkeley. We invested in frankly some of the first women and people of color and our venture capital industry has been terrible at investing, as you know, in women and people of color. It's slowly changing, but we're willing to take risk, and I think that's there's one other thing I want to mention is the whole concept of risk, which people rarely talk about or rarely understand. You have to take risk to start a company, and I think having a very serious conversation, with your investor, whoever may be your prospective investor, about risk before that person invests or before that organization is really, really important. How much risk are they willing to take? How much risk are you willing to take? And make sure you're on the same wavelength there, because if you're not, it can definitely cause relationships to go askew.
So you're investing in mid-stage startups that have gotten past the bootstrapping stage. They're looking for growth capital. You like to be the first person in. You're willing to get on planes. Most people aren't willing to get on 2 planes. So how did you arrive in Montana and with your investment in RightNow?
That's a really good question. At the time, it was 2 planes from. There was no nonstops. And we had. We've been in Montana for 30 years, up near Clyde Park, and spent a lot of time there, and got to know a few folks. But I'd heard about this company called RightNow, and just kind of heard about it. And I was trying forever to get a meeting with Greg, and wouldn't return my phone calls. By the way, this is pre-internet, email and stuff. It was just starting. It was the late 90s, just starting. And we actually used the phone back then. And I couldn't get a meeting with him. And finally I did 2 days before Thanksgiving, finally agreed to see me. And he was in that building. And for those of you who know Bozeman, the old life insurance building at the end of town. And I went and met with him, and spent a couple hours with him asking questions and told him about the company. He had not taken any venture capital at all. He had just bootstrapped it and had some customers and was growing. But this was 1999, and plus or minus. And we had a great conversation, and we had 2 hours. And I thought, wow, I have a great relationship with this guy. He's gonna extend an offer to invest. And at the end of the conversation, he said, I just signed a $15 million term sheet with Greylock, and to be the investor. So I was like, oh, great, thanks, Greg. And I spent 2 hours with you, and we kind of left the door open. And I went home, and I told my wife and kids about it, how exciting a company it was, but it didn't have a check. And so at 9:30, my phone rings, and it's Greg. It's Greg Gianforte, and I said, oh, it's Tuesday night, and he said, well, what are you doing tomorrow? So, well, I'm probably gonna be getting ready for Thanksgiving, cooking, etc. And he said, well, did you really have elk on your place up in Clyde Park? Do you really? And I said, yeah, we see them. And so, well, I'll see you at 6 o'clock tomorrow morning, and we're going to go hunting. And I said, I've never hunted before. I haven't held a rifle since summer camp. And he said, no, we're going to go hunting at 6 o'clock. I'll meet you. And so, boom, hang up, and we met at 6 a.m. Remember driving a pickup truck and went through. Going back in the ranch, or driving, is dark, and all of a sudden a herd of elk streams in front of my headlights, and I said, thank you. Long story short, he never got a shot, but he was so happy that a month later he called me and invited me into the deal, and then we wound up leading the second round. So Greylock led the first, we led the second round. So. I guess the moral of the story is have a relationship, and know what your entrepreneur is really invested in. And so it was Greg. So why was RightNow successful, and why does Summit invest in RightNow in Montana? Because at the time it was unprofitable. It was, but I think a few things we saw. One was giant markets to be served, the whole customer service market. Two, they adopted a new SaaS was just coming on. They're one of the early SaaS companies, so that was of interest to us, and a great business model. Obviously the SaaS model is successful, is very business. Greg, for those of you who met him, whether you agree with his politics or not, he's one heck of a salesperson, and he's a really good business person. And so that was another thing. We spent a lot of time with him and got to know him, and that was intrigued us as well. He built a wonderful team already. He'd populated his senior staff. Susan had either started or was about to start. Mike Meyer was his CIO, so he knew how to build a team. So all those things conspired, for us to make the investment. And it was a little scary. We had to really hold our breath. This is 1999, and valuations were through the roof. And it was a little scary to make that kind of at that price, but we did it, and obviously we're fortunate enough to be successful.
So you were setting yourself a different landscape than most VCs by looking further afield in Ohio and Georgia and in Montana. How was it that something or someone like Greg and RightNow even got on your radar to begin with?
Well, I found it by ripping out an ad, a help wanted ad in the Chronicle, or might have been one of the tech, high tech rags at the time. That's how we found companies. I used to troll the aisles at Comdex. For those of you who are too young to know what Comdex is, a big trade show in Vegas where thousands of companies, and you'd walk up and down and try to find companies. Now, a lot of that is done by the internet. Summit now is using AI to find companies and establish a relationship with them. So that's changed a lot, but there's still a lot of outgoing research and efforts to find companies. So we put together a pretty sophisticated database and CRM system, Dawn, to stay in touch with companies. So we just didn't wait for the phone to ring or for opportunities to come in. That said, and this is what we'll maybe talk a little bit about. That said, when we got a referral, from someone we knew or trusted, immediately, of a lot of frogs, that frog all of a sudden, went to the top, because we're trying to sift through all these frogs. So having, some type of network that you can get a referral from, is also extremely important. So that is, I don't know if I answer your question, but that it was we traveled so much all across the country then, and to the extent where we'd wind up, a few times, and we laugh about this, a few times we wind up in cities and wake up the next morning and forgot where we were. And because it was that, and we just wanted to also show our entrepreneurs that we're willing to work as hard for them as they were willing to work, for us. And I think that's really important to have that relationship.
So you mentioned earlier about a spreadsheet, and there's been a lot of discussion in the entrepreneurial community about how necessary a robust set of financials is versus an entrepreneur with enthusiasm and a big idea. Can you delve into that a little bit more?
Yeah, I'm most interested in, you'll get, by the way, you talk to 10 venture capitalists or 10 private equity, you'll get 10 different answers. Okay. So don't, it's on that one. So, and that's the thing about our business is it's incredibly heterogeneous. Every firm has a different strategy, different ethic, everything they're looking for. And, very different than, say, the banking business, where a bank's kind of a bank, and investment banking is kind of an investment bank. But I would say there's a match out there. But my answer to that is I really want to understand the unit economics. The unit economics of the product, what it costs to acquire a customer, what it costs to develop a product, how it scales, what happens. If I can understand that, to me, that's the most important thing, is at the unit economic level. And then, the spreadsheets, they never, ever in my history of investing in companies, the hundreds and hundreds of companies, and we should do a statistical analysis. I bet how far off the spreadsheets were, the 5-year projections were from what actually happened, usually below, and 90% below, but occasionally you get one that outperforms. So, those 5-year projections are nice to talk about, but understand the unit economics and how that scales is far more important. And numbers help support that versus just words. But that's, for me, the most important thing.
So you mentioned your second investment being somebody who defrauded you. That may qualify for my next question, which is, what are your worst investments you've ever made?
That was one of them. And I made the mistake I made, and I also, this is a word, just kind of advice for those of you who are doing any due diligence on anything, is, I was calling customers, and the customers in this particular case, when a customer has recently bought a product, they'll tell you it's great because they want to affirm themselves. They want to affirm their purchase. They went on a limb to go to their boss to get this thing purchased or whatever. So even if they haven't used it, or even if they're just in there, they'll say it's great because they want to affirm their purchase and their job and their position. So I learned over time how to get to the right person and ask the right questions rather than just how's it going. So that and that I think that's also important for an entrepreneur as well, when you are out trying to source product or whatever, source materials or whatever. I think it's really important to know how to ask the right questions. And by the way, that's the most important part of being a venture capitalist, is asking the right questions, is not having the answers, is asking the right questions of entrepreneurs. So that, I'd say that was one of my worst ones. I would say another one that I remember in Ohio, although we had a couple of, we had a very successful landfill gas, landfill gas containment and extraction company. They had a little bit of a tech element to it in Ohio, but another one that was in environmental services that just the plant wound up blowing up. It just exploded, and I just saw our dollars just flying up in the air. That was another awful investment. That one we couldn't help. But the ones, and as venture capitalists, and even though we're further out on the risk spectrum, we take a little bit less risk because the companies have a little less risk. But we have to be prepared to lose money. If you're not prepared to lose money, you're not going to be a good investor, period. That doesn't mean you should try to lose it, but you have to take some risks. So I would say our hit rate, in the early stage business, it's much less. Our hit rate was probably, I'd say, 8 of 10 of our companies either broke even or made money for us, and 2 lost either entirely or fully. And of the 8 or 10 that either made or returned capital, I'd say 3 of those we got our capital back, and then 5 we made money on. And
was it
so
surprising to you which was which on that? Was it surprising to you? Like, everybody takes their bet, right? And the ones that fail sometimes surprise you. The ones that win sometimes surprise you. Did you have any inkling about your bets you're placing?
The answer is usually yes, but not the magnitude, because a lot of times the magnitude is out of our control. How strong or weak the exit market is when you have a strong IPO market. So you make your money as an investor, 2 or 3 ways, right? You buy right, and then hopefully you can buy right, and hopefully the market also, and the company grows, and also hopefully the market multiples for the companies expands while you're investors. So you can have that compounding effect for the real successful ones, and the last one certainly out of your control. And we never try to time markets, ever, never. But I know we want to go to questions here, but I do want to point out one thing, because I know there's probably a lot of questions about what's the market like now, what's it like to raise money in Montana. I think at the higher level, I believe that the market is going through a sea change, and will come out a much different market. Venture capitalists who are in the market are having a hard time raising money, raising as much money as they wanted to. Certainly the brand names can do it, but that's difficult. A lot of venture firms won't be able to raise money, so you're going to have a decrease in the number of firms. I think the good ones will survive and prosper. I think a lot of the excess will be out of the market. I think venture capitalists, frankly, do a disservice by overfunding companies, which we were guilty of in the years leading up to 2022 and back in the dot-com era. Here's a ton of money, spend it, and if you don't have the discipline, companies wind up not having the discipline to build a business. I think that excess has come wrung out of the market. Maybe now the exception of AI being the big exception. So I think it's going to become, while there's a lot of pain, I know right now on both sides, I think we're going to come out of this in a much more balanced market.
And I think Jenny wants to go to Q&A, even though I have many more questions
I
about.
know, I'm sorry to interject, but I see everybody chomping at the bit and I want, some of these firsthand kind of like tactical questions for startups to be answered. So before I go to Q&A, how about I am going to have everyone in the audience unmute, and I just want to give Dawn, Greg, and Philip a round of applause for that conversation. I hope you learned a lot.
Thank you so much. That was
You can tell Dawn's a very good investor because she asked some really good questions.
Right.
Absolutely.
Thank
So
you.
I am just going to go quickly to the watch parties. If you guys wouldn't mind just remuting yourselves, just in case there are dogs barking in the background. But we are going to go quickly to a few of the watch parties. Let's start in Bozeman, since we've got a crew of you there. Do we have one question from Bozeman that we would like to pose to either Dawn or Greg?
Greg, Ryan. I was wondering what advice you had for the Montana ecosystem, like what we can do to make this place more interesting. Like, I think lots of people love living here. I think there's desire to have more tech community, but what are your thoughts on bringing more?
From a company standpoint or from an investment standpoint? From a company formation and growth standpoint or from an investment standpoint?
So I think from company growth. So like, right, we started a company, we have 3 people in Bozeman. Right, we're thinking about how to grow, and so what would your advice be for that?
Well, it's interesting. And I've invested in 4 or 5 companies in Bozeman. The CEOs would be much better at answering the question than I, because they live it every day. I know when we first started RightNow, or not started, when Greg started it, and first, even though he'd hired a couple senior management team members, he felt at the time, and maybe it's changed, that it probably has changed, that attracting senior people to the Montana at the time was difficult, because there was such a small community of firms that if it didn't work out, they'd move their family all the way to Montana, and now what do I do? And this is obviously before Zoom and people working all over the country and the globe. And so that was, and now probably probably the opposite, is a senior person coming to Montana could be a potentially a real positive, particularly somebody potentially later in their career. So that has changed. Clearly, living here in Silicon Valley for 35 years, what makes it work, we obviously have world-class universities, way past the tipping point in terms of critical mass to have transfer of knowledge and hire great people, and all that stuff is great. And so Bozeman/Montana, is not going to replicate that anytime soon. But what Montana does have that don't have here is, one, it's an attractive place to live. 2, it has, now I think critical mass might be too strong, but I think it's got enough people that there is some synergy, firms building on firms, and so I think we're at the early stages of that. I would have guessed, frankly, that after RightNow was sold, if you said, would there be more companies that have spun out of RightNow and more, I would have said probably. I would have guessed that, but I was wrong, and you may know why more. Even with the pandemic, people moving to Montana, which might have be not related at all, I would have guessed more. But and I think it's so I would say, I'm not sure to answer your question, but I would, you have to be willing to have a dispersed employee base, because you may not be able to attract people, and you may not have certain skill sets you can bring to Bozeman. So you have to be willing to do that. It's sacrificing potentially company culture if that's an issue. You have to be willing to travel and go see customers, because there is no substitute for, and that's one thing that made Greg a really good entrepreneur and CEO, is that he would get on the road and he'd go and talk to customers up front. And there's nothing like a CEO to do that. And so a CEO has to have people that he or she can leave their operation, and they can go out on the road and trust the people that they're running the show. So I don't know if I answer your question, but I think it's not easy, as you point out. But I think if you're willing to hire people outside, willing to make use of contract help, and willing to get on an airplane, you can be successful.
Great. Next question, I'm just going to take some questions from the chat. Greg would like to know, what is the first question that you ask an entrepreneur?
I usually ask their background, and how they got into starting the company, and their background, not just, boy, I was working at Salesforce and I got this idea and I left, and it may not be the first question. I'd like to understand, a little bit about, where they either grew up or where they came from most recently. Really understand a little bit of their life story is where I start.
I'm curious, I'd love to hear the same from Dawn. Dawn, what's the first question you ask an entrepreneur?
I really think what makes them happy. Like, what is the thing that makes them get up in the morning and really be glad of the day?
Interesting. Okay, next question. Carrie would like to know, what trends do you see shaping the future of tech entrepreneurship over the next decade? And how can today's entrepreneurs prepare to take advantage of these trends?
This is the question that Philip knows I was afraid of when he first asked me to do this, because being in the business for 40 years, I feel a little bit like a fossil. And so if you ask me like where AI is going and where all that, I can't answer it. I think there is, so I think there's a constant. I mean, one thing that happened, and this is, I'd be really interested. One thing that happened during on our watch was this whole, with the advent of the internet, and was this whole first mover advantage, and the companies that get big fast, like the company Phil works for, get big fast. The network effect. We back in the old days, we could invest in the number six disk drive manufacturer and be successful because there were 10 of them. And now, if you can't invest, you couldn't invest in the number 6 search engine manufacturer and be successful, right? There is this network effect. You have to pick the winners of the big markets, but that doesn't mean that there aren't niches around the really big, and frankly, that's relevant to, I think, Montana. For Montana to think it's, and again, this is nothing against the quality of the people in this room or the investors or wherever, it's extremely difficult to attract the capital and the resources to build, the next Apple or whatever. But there are niches, within the ecosystems that these companies create, to be successful. That is not going to go away, for sure. And I think that's number one. I think that's a trend. And I think secondly, it's interesting. I also think on the way up here, I was listening to an NPR show about smartphones, and a New York Times reporter who had given up her smartphone and used a flip phone, and how that made her happier, better, equally effective, all this stuff. And so I think there's an opportunity to get out of the mindset of the next app, the next connectivity, whatever that can increase productivity, and define in Montana ag tech, climate technology, other things that actually make the world a better place, and may not necessarily attract the big dollars that say AI is, etc., but to find those niches. So I think that's another opportunity. This fusion of impact and profitability and return on investment that I think is going to become more and more important, because they're not. Dawn knows this better than I do. they're not separate things, impact here and successful investment over here. I think there's gonna be more and more opportunities. People seek community, for example, seek a cleaner planet, seek healthier food, etc. I think there'll be great opportunities in those areas.
All right. Well, Greg.
Dawn, you've invested in that. You may have another opinion on that.
No, I actually was just going to ask a follow-up question and whether any of your current impact investings are going into climate and to whether and the other things you just identified, is that where you're placing your money and your bets now?
Yeah, a little bit. I invested here in a company that's in the solar area. Invested in my first B Corp that has developed a platform to help candidates, down ballot candidates, run their campaigns. In the political sphere. If you're running for president or Senate or House, you've got very fancy systems to do your emails and your campaign management and your door-to-door campaigning, et cetera. But if you're down ballot, you're usually working with your spreadsheet or a legal pad. So invest in a SaaS company that helps a B Corp that helps them. And it's not climate or ag, but it's an impact related investment.
Jenny, do you have more questions, or am I allowed to keep going?
I have one comment and then one question that's a little bit tactical that I think you could probably answer really quickly. So the one comment is that Philip says in the chat, I'm not sure if you're reading this, Greg, that your wisdom is timeless, and everybody else piled on saying, that this is really interesting and fascinating. And so thank you so much. I could not agree more that your wisdom is timeless. And this has been really interesting to listen to. With that, the one question that I think would be interesting for you to speak to the entrepreneurs in the audience around, and I hear this question a lot, there's a bit of tension there, is how, with the unit economics, I thought that was a really interesting point that you wanted to understand around financials. So can you help us maybe give us some insight into how you think about how one should address unit economics with investors in your earlier stages, like before they're talking to you? And so getting to your first 100 clients that costs a lot of money, and figuring out the unit economics right there, that's a challenge. There's a bit of a paradox. So can you walk us through maybe advice for startups that you would have there?
Carolyn, that's a really good question, and I don't have a complete answer for it, because you have to make some assumptions, right? That over time, customers acquisition, client acquisition will go down. So you have to make some educated guesses on that. I think pricing is one area that I know a lot of people I find a lot of companies trying to figure out pricing, and my advice is start here. It's much easier, if you're delivering a great product. To raise your prices over time is something that you want to obviously better than lowering your prices. But I think that's another assumption, that it can be conservative on your price. Start conservative with your pricing, and then see how it looks over time. I think the other thing is I think companies tend to underestimate a lot of their costs associated with supporting their clients, customer support, etc. So I always push on that one. Make sure you got enough customer support cost built in. So it is, Carolyn, it is imperfect for sure. But I think what we're really looking for is, as an investor, does the customer value the product? Are they willing to pay something for it? And then, you can have some evidence of what it would cost, to acquire that customer, and you're gonna have to make some educated guesses over time. But I think that the companies that I've gotten into trouble on, not besides the one where I either defrauded or I defrauded myself, or where I underestimated the costs of customer acquisition, for sure. And I think that is, so that I think that is, and that's a little bit as much art as science to figure out what that is, but you can talk to, you can look at what some companies in adjacent industries have done. You can get some data on that. You can talk to your investors who their experience with other companies. But I think it's generally, it's a big mistake the companies are. It can be very expensive. And by the way, this is not just in the for-profit world. This is also in the nonprofit world. I say Bridget Wilkinson is there. It's very difficult as well to find donors, et cetera. But once you get the flywheel going, it's getting to that flywheel point where you've got systems, you've got a model. You may have to. It might be bumpy until you get to that point. And you have to have an investor and the capital to be able to get through till the flywheel starts rolling.
I see that Philip raised his hand. Go ahead.
Yeah, quick question. You talked about bootstrap companies being your main target, and I understand that your formula is to go after companies that are a little more mature and established, have a little bit of a track record, and see that road to profitability. Yet you want to be the first money in, and that really leads to naturally to companies that have been bootstrapped up to that point, that haven't taken earlier stage seed investment or Series A investment. So it's understandable that makes sense from your point of view. Do you think that bootstrapping companies that are not capital intensive, as you point out, where you can, is a good business practice? Is it better for founders to bootstrap and raise money later?
Again, the question, it depends, but certainly it depends. Your best source of capital is your customer, right? If your customer is willing to pay you and give you some money that can help you get the next customer, that does a couple of things. One, it validates your product. Two, it gives an investor that comes in later, just what we were talking about, evidence that there's value there's a value proposition here. But I think that's hard. I just invested in a company in Bozeman called Alisant, and I don't know if April's on the call, but or Mike, but they had managed to bootstrap their business, took a little bit of money from some local investors, but gotten to a nice revenue rate. It's taken a little bit longer, but longer than it would potentially. But they potentially also, April might say, they weren't ready for a big injection of capital. So now they're ready to. They've got the flywheel going, and now they want to increase the speed of the flywheel and make it bigger. So I think Philip, it varies. Some businesses you have to have capital, up front, big capital expenditures up front, and that would preclude the bootstrapping strategy. But I think if I had a wish for Montana, that somehow, and I know there are networks of investors and angel investors, et cetera, but there's a lot of money in Montana, and there's a lot of venture capitalists and retired venture capitalists and venture capitalists of second homes and blah, 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 that if this somehow could get organized, because my connection to my investments in Montana have been through relationships. And if there's and I know a lot of you, Dawn nodding her head, have tried to organize networks, but somehow if that process could be, I don't know, made a little bit more transparent and accessible, I think we'd find a lot more sources of capital for that earlier stage capital, the friends and family money that I call it, that can get a company to the point where it's ready to either professional venture capital or a bigger injection.
Greg, I know you've made some unique investments in Montana. Is there anything that you're looking for on your horizon right now for people who are listening to this conversation? Might they be your next frog that you kiss?
No, I'm just really, we all love Montana. And I'm just, at this stage of my career, I'll answer a couple differently, is that I'm looking for people that would be enjoyable to work with. And life's too short for me and life's too short for that entrepreneur to not have a good relationship. And in fact, it's been one of the the things I miss most about my prior firm was, one, mentoring the junior people in our firm, and two, having, at the time I was on like 15 boards, and the relationships I had with entrepreneurs. I miss that the most. So number one, people to work with. Two, people that are bringing, making life better, making the world better. And I think that, so that's of interest to me. I think the also advantage of working with, I think there's the other thing that's happening in the venture world is venture capital firms are really important, professional venture capital firms, but they have restrictions, right? They have to get their money back to their investors in a certain period of time. They have a pretty high bar on their rate of return. They can potentially have big reporting requirements. There can be a lot of things, but there's a whole other tier: family offices, individuals, friends and family, et cetera, tiers of potential money that I think can be attractive in the ecosystem. Harder to tap, Dawn, right? Because it's less organized. But I think that's one more thing about your question. What I'm looking for: so people make the world better, people that are fun to work with, and also people just who have a sense of urgency, but it's not about making the money. If I get nervous, anybody starts talking about making money in the first 5 minutes of my conversation, or even the first hour. If you do the right thing, if you have the right product and the right people and the right sense of urgency, the money will usually follow. So I really want people to focus on those things first.
Thank you, Greg. It's been delightful to be in conversation with you today.
It's been a privilege to all.
I'm gonna have everyone unmute again, and let's give them a round of applause. That was a true pleasure. Thank you. I just
There's clapping, so we can't actually hear it.
Oh, you're
I just want to thank everyone. Thank you so much, Dawn and Greg. This was an absolutely delightful and super informative conversation. I really enjoyed it. I really learned a lot. I see lots of comments in the chat, echoing those sentiments. So really, really appreciate your time and sharing of your wisdom here. And of course, I want to thank everybody for joining us today and taking time out of your busy schedules to be part of this and to be engaged and ask great questions. And we look forward to seeing you all at future events. And I just want to make sure everyone has on their calendar that our Scaling Montana Summit is coming up. Our annual summit is coming up on October 24th and 25th in Bozeman.